Morning, everyone. Sorry for the late start. More headlines hitting the wires just as we're in the show. China state banks have been told to stock up for yuan intervention offshore. That's Reuters sources with that one. As you can see there, dollar yuan taking a hit. Keep an eye on that one. I've just jumped into a small short at 18.50. Going to see how that plays out, but more talk from China there. Morning, Kay. How you doing, mate?
Good morning, Ryan. Good morning, everybody. Yeah, I saw that too. Yeah, we're a trader, right? You have to jump in those things.
Yeah, I didn't catch it as quick as I would have liked, but yeah, I'm going in with a bit and see what happens to the rest of it.
Yeah, me too.
Yeah. Right, anyway, so here we go again. Please, no bank officials with any more comments or big interventions while we're doing the show, please, because you just throwing everything up in the air. Anyway, good morning, everybody. No still today by the looks of things. Busy on the Traders Summit stuff, which you guys will be able to come and join once we get all the links and stuff out. Traders Summit in October. A whole host of speakers. For those that may not know, we get a whole host of speakers. It's a whole weekend event, Friday to Sunday. Lots of interesting speakers on there. We've got some really cracking guests coming up from that. You can come in and watch that, but further details to be provided shortly. Right, let's get stuck into it. Keeping half an eye on my trading screen there. Right, it's been another central bank deluge. Today and this yesterday and this morning. So let's start with the US. The White House said that there's no definite reason why Yellen would be leaving after the midterms. No plans for her to leave. So that's a bit of a quash there on that factor. We've had Fed members out, quite a few of them. A lot of them are all just blustering on about the usual stuff, but I've picked out Evans because he says that he sees the rate getting to 4.5 to 4.75% by year end or March, and that the rate could sit at that range for a long time. Now we're into that part of the year where we need to get the calculators out just to work out if central bankers are giving year-end predictions for rates. We need to know how many meetings there are. We can get a fair idea of what they have to do if they're going to meet those potential targets. Obviously, it's not set in stone, but if we take Evans, if we're to get to 4.5 to 4.75% by the end of the year, we're currently, Fed funds are at the 3 to 3.25%. So that's going to mean 150 basis points of hikes over the remaining 2 meetings. Easy to work out, 75 pips each meeting. Obviously, if that's going to be, in his words, maybe by the end of March, that's 4 meetings, then it changes the picture a bit. And the same for the ECB. ECB's Ren was out this morning. He says he expects the ECB to get to neutral by Christmas. Okay, so what does that mean? Again, we've got 2 meetings coming up left for the ECB this year. Rates at 1.25% on the main rate, deposit rate 0.75%. So let's say 2 meetings. He's quite hawkish, or very hawkish actually, Ren. He's yesterday said that the ECB should go 50, 75 or something else. Let's put him in the 75 pip camp. Let's say the ECB hikes 75 pips over the next 2 meetings. That will put the main refinancing rate quite high at 3%, and it will put the deposit facility 2.25%. Is that right? Yeah, 75, 150. Yeah, 2.25%. That's probably a very hawkish assumption compared to where the others are. Maybe, I did say maybe today, based on those numbers, the ECB might get to 2.25%. I'm thinking maybe it might be 2.25%, 2.5% now. That's where I think the general consensus is where they're going to get rates to. If they go to 75s, obviously it's going to be up near a 3. if they maybe only go 250s or 175 and a 50, whatever the combination. I think 3% is going to be the very top end for the end of the year, and then between maybe 2.5, 2.25, 2.5 from the rest. It's important to know this because this is what the market's going to be pricing. It's going to price what's going to happen at year end and then what happens after. Now, if the ECB get to their neutral rate, and remember Lagarde hasn't got a clue and some of the others haven't got a clue where that neutral rate is, or if that's a pause rate, then the market is going to adjust its expectations for the new year. And we always get those expectations a big part of market pricing as we get into new year, at the end of the year, market pricing what's going to happen next year. So keep an eye on that. Some of the other members, what they're going to say about where rates are likely to be into the year end. Now, ECB's Kazakhs was out. Again, just to reaffirm what I'm saying, he said 75 pips would be his choice for October, but then smaller steps afterwards. Does that mean a 75 and a 50 is his base case, a 75, 25? Again, it's just jumbling up the numbers a bit. Onto a slightly different subject, ECB's Muller said that FX is proving important as it impacts CPI. It's maybe becoming a problem as it's impacting CPI. So more talk on the currency, more talk on its impact on inflation. As the currency drops, inflation increases by way of making you have to spend more if you're buying stuff in dollars. For example, a lot of energy imports, that sort of thing, those become more expensive as the currency drops, adds to the inflation picture. Kay, what do you make of those two central banks at the moment? Fed and ECB?
The cost was just out saying the Spanish ECB member was just saying that Bank of Spain sees the terminal rate at 2.25% to 2.5%. So I think we are sort of converging towards that level, which makes relative sense because that would put real rates slightly positive if they succeed, which is another task. If they succeed to bring inflation back down to 2%, they're all on this kind of scenario. Well, what it inspires me is that it still says it will be likely below the Fed's
well below,
to whatever rate they are trying to get to and then stabilize around. So yeah, ECB will like, in my opinion at least, likely be still behind on where the Fed will go to or end up at. So yeah, I mean, that's my view for now.
Yeah, definitely, mate. Right, let's move on to the Bank of England, the mess that's going on in the UK. Now, obviously, we had all that breaking news during yesterday's show that they will be in the market each day for the next 2 weeks, buying up to 5 billion per day of gilts over 20-year maturities for a total spend of 65 billion. So up to 65 billion they'll spend. Yesterday, they got 2.6 billion in offers and bought an actual 1.02 billion. So well below their 5 billion a day limit they've given themselves. Now, as the day progressed yesterday, we got a bit more in-depth news about why they did this. To cut a long story short, they did this aiming specifically at the pension sector, who apparently got their knickers in a twist over something called an LDI. Now, I don't claim to be any sort of expert on this, but I've looked into it as best I can. LDI is liability. I forgot what it is now. Liability-driven investments. Basically, it's a form of leverage where, because rates have been so suppressed everywhere, these pension guys, because bonds are a big part of their portfolios, rates are obviously really low. They've got into some sort of leverage trades to try and maximize those returns. That's not been exactly the killer for this, but what's happened, these bond moves in the long end have been very volatile and the liquidity has dried up, meaning that when they get a margin call, they usually sell bonds as part of that to pay for the margin call. Now they're selling into a very low liquidity market, and it's become an issue where they couldn't sell enough bonds or raise enough cash to pay these margin calls due to the volatility. That's why the Bank of England has had to step in. So this is a specific measure for this sector. This isn't the Bank of England stepping in because of everything that's been happening in the gilt market and the government policies and everything like that. This is in effect what's happened is these jumps in yields have caused a big traffic jam, if you like, on the motorway that is the UK gilt market. And now what we're seeing here is that traffic backing up to a junction, and now it's affecting the smaller roads because people can't get onto the motorway. So it's a chain reaction effect, and one of the sectors that have had a problem is the pension sector. So these little things may start popping up in more places, in more countries, different countries, as this yield situation continues to move. It is not going to be UK specific. I can tell you that. Already I'm reading some people saying that the CDS market is on the move. Credit default swaps, that's the market where people start getting nervous if they feel that debt is becoming overburdened and people can't pay stuff back. So we're probably at the start of what we're going to see other financial instability risks coming up, or financial stability risks, if you like, coming up. Now, the funny thing was yesterday in a day of headlines, so the Bank of England are basically adding to their balance sheet, and then 5 minutes after they announced they're going to be adding to their balance sheet, they cancelled a speech for today on balance sheet reduction. So that was a bit of a light-hearted headline that came through, pretty much summing up the situation. Now, what happened is that we saw that dip in bond yields around the globe, really everywhere. Saw a dip in bond yields yesterday. As you can see there, we came off the highs in US 10s, pretty much came off the highs in a lot of bond markets. They've stabilised a bit today, but what the BOE did yesterday was pretty much rattle the cage a bit. They gave the market a little nudge, and the market got a little bit worried that, okay, central banks are now starting to have to step into some of this stuff. And I think that's shaken up a few people. We can see from the bounce that it's not shaking it up too much. I doubt it stopped the rot in both yields and the currency moves, but it may have injected a little bit of stability for the short term at the very least. We've also seen rate expectations dipping yesterday. 75 pip hike probability for the ECB yesterday in the morning was 90%. It dropped to 40% after the BOE action. So nerves jangling a bit, the cage has been rattled. Kay, what do you make of all that from the BOE?
Yeah, just one thing on sterling is actually ramping higher here this morning. We're almost back at 109. I'm starting to think we may have some stealth interventions also. It's really flying. We're back at 109 now, and the sterling crosses are ramping higher. Okay, first of all, I have a little thought about those interventions in the bond market where they only did like 1 billion sterling or so. I do think that some of the major players or players, not in the sense of speculators, but those pension fund and things, they have not been willing to sell bonds at those high prices since the Bank of England is intervening. So I think they just wait for better levels. If they still need to do something, they wait for better levels. So in my opinion, it's not really a big surprise that they only did a part of it, because that's the thing. Like if you look at an intervention, if you translate it to foreign exchange, for instance, and dollar yen is trading above 145, and BOJ calls you up for a price in dollar yen, are you going to to quote 145, 75, 80 if you know that you're going to get given anyway. So you are going to quote 144, 70, 80 or something of the likes. Only the fact of intervening is already perhaps scaring is a big word, but is already holding back people from getting into the market. So I think that's the main reason why they only did a small amount yesterday. We will see the next few days as their planned interventions go on. We will see the next few days if the amounts start to go up or not. So that's the thought that I had for the first days of intervention. And for the rest, globally, okay, they don't want to cool the market because the economic situation is so great and yields are going up, and because everybody wants to invest in UK right here and now. And I'm talking short term, right? I'm not talking about longer term here. I'm just talking about the short term. So I'm a little in that. Well, I understand that the CDS market is creeping higher because the people really want to know what's going to stand in front of those expenses. If you in a weakening economy where there's already risks, because it didn't start yesterday or even with Truss and Kwarteng, they are the ones to blame because they pushed the pedal and the market went boom. But it's been lingering. It's been coming. The UK data, although not falling out of bed, have been weakening of late, retail sales and everything, and it was just the trigger, I think, for what happened. So I understand that the market is not really thinking that this is going to help a lot. So I'm going to remain on my toes for what sterling is concerned. I can't really buy sterling on the back of their actions. Let's put it that way.
No, I thoroughly agree with you, and I've been blustering the point all day yesterday because people are still laying this all at the hands of the UK. This pension thing, this intervention thing, has been the cherry on the top of the cake, not the cake itself, compared to what's been happening in the yields around. But you guys and girls know that because we've been banging on about it long enough. Just checking my notes and bits and pieces. Okay. Oh, right. So on top of the PBOC stuff that we got this morning, they were out in the Security Times early this morning, which is a state media press paper, and saying that yuan is unlikely to continue depreciating rapidly. Okay, so that's before we heard this headline this morning that's done some damage there to dollar yuan. Oh, look at that, now down at 614.82. Lovely jubbly. Okay, give me 2 seconds. I'm just going to take some money off the table. Okay, that's done. You don't get trading much liver than that, folks. Kay, you got any headlines or any news you've seen that you want to jump in on?
Real news, nothing. I mean, the only thing we see is the wires, the articles, everything. It's exploding, but it's all opinion pieces, and I think this, and we should do this, and they are wrong on that. But real news, no, I haven't seen much real news. The only thing is, yeah, it doesn't seem to that anything gets solved around the Nord Stream pipelines and whatever. And although the Germans say that they are about 91% loaded up on gas reserves, they did also say that the consumption of gas has seen a rise lately. So I think the uncertainty surrounding that is going to remain with us for a while. So that's still the ongoing uncertainty and ongoing weight around the euro's neck underlying. But I haven't seen any fresh news. No. Just maybe a timely reminder that we are end of month, end of quarter, end of semi-fiscal year in Japan, and that traders should be aware of that, and that we could see moves out of the blue which are not in line with fundamentals, which are going against trends, or which accelerate moves more than what they really should do. So keep that in mind when you're trading, and when you don't understand some of those moves, especially around fixing times, which are basically every hour of the day, especially in the European morning. And then come around 4 p.m. London time, 3 p.m. GMT, there could be some really nasty moves, or non-fundamentally justified moves. So bear that in mind when you're trading.
Yeah, exactly. Just looking at some of your questions there. LDI sort of creating new tools that will get the work done instead of central banks. No, it's really it's a derivative that's been dreamed up by pension firms to try and maximise the fact that we have been for years in a low rate environment. As mentioned, a lot of pensions are made up of bonds because they're relatively safe and secure, give a guaranteed income, but it doesn't really work when yields are at 1% or less, because you're not getting good returns. So the old classic leverage gets used to ramp up those small returns into bigger returns, but obviously it comes home to roost when you get a decent bit of volatility or something in the market changes, and that's what's happened here basically. But it has been a margin issue. It's not saying pension companies are going under, well, unless they can't pay their margins, of course, but that's what's happened. They've created leverage, used a leverage structure, and it's they're getting their fingers burnt. Liz is saying USD weaken on people front running the China yuan intervention. Yeah, possibly. Another big shake. Obviously, China is a big deal. If they start moving, or currencies start moving there, that might be a little bit behind the dollar move we're seeing, or other currencies rising. We'll keep an eye on that. Keep an eye on yields as always to see what they're doing. One of the drivers as well. Right, so just a quick rundown of a bit of data this morning, because we're getting some CPI data, prices data coming in from the Eurozone flash numbers. Spain with a drop back there and inflation to 9% in the CPI from 10 expected and 10.5 prior. We're still in very, very volatile times for inflation numbers. The HICP, the Eurozone measure, 9.3 from 10.1 expected, 10.5 prior. On the other side of the coin, Italian PPI for August, jumping up to 40.1% from 36.9%. Okay, so this is lagging CPI by a month, because we're just getting September CPI numbers. Germany had their regional CPIs out, not on many calendars. These were all jumping significantly. We saw moves from sort of 7.8% up to 10%. So a big jumps in CPI numbers from the regional Germans there. However, there is a skew, something we've been talking about over the past couple of months. There were some government subsidies for transport, i.e. cheap train ticket promotions being run through the summer. I believe they were June, July and August. Those have now dropped out, hence why a lot of this jump in CPI is down to that factor. So a lot of people raising eyebrows at German CPIs jumping to the 10% marks. A big reason of it is the subsidies coming out of that calculation. So not quite the shock. If we're at these levels again next month and the month after, then people can start flapping about it. Eurozone consumer confidence and business climate, softer, no real shock there. The big numbers for the ECB are these: the consumer inflation expectations jumping up to 41.3, selling price expectations, the prices at which firms think they can sell prices, rising as well. So when you talk about the ECB, one of their big parts of their mandate is price expectation, what consumers think about prices, and they like to keep those, as they call it, well anchored. Now, if we look at these, I don't believe we're on fresh highs for these numbers. Let's have a look at the chart. I think we had highs and we came off of those. Yep, we did. So we had highs well back in the beginning of the year. We've seen those expectations dropping a bit. That's good news for the ECB. It falls into their keeping prices anchored. Let's see if this one is a dead cat bounce or if we're going to start another leg back up towards the highs in those expectations. As I say, big for the ECB. What else we got coming out? As I say, the main German CPI numbers there coming out at 1 o'clock, London time, 12 o'clock GMT. Again, just to reiterate, expecting a big jump there, 7.9 to 9.4 CPI, 10% from 8.8. We know why that's going to happen. Some Q2 numbers from the States, last readings probably, old news, review stuff, nothing to see there. Jobless claims, keep an eye on those as we do to see if there's any trends developing in the jobs market, which plays into the Fed's hands, of course. All else, tons of Fed speakers and whatnot coming up later. Looking forward to that. Not. Right, let's get into some price moves. Let's look at the quid. It's all over the shop. The volatility is still very high in here. I'm not looking to touch it again. I can probably see this as a, let's go on the other chart. I can probably see this as a missed opportunity down into that 105.20 level. I was looking at that area to see if it held again after we had all this mess going on here. It got down to 39s, probably close enough. That's in the rear view mirror. Another test down here will be interesting to look at. If it starts developing real good solid support, then we've got the potential for a real bottom in place. That's been lacking in a lot of the moves we've seen over the past weeks, being able to find a decent base to build any form of support of. It hasn't happened anywhere down this move this year, late last year. So that's what you look for. When you want to try and pick your bottoms, you need to have some confirmation that a bottom is a bottom. And that usually means multiple tests over a decent period of time and a level keep holding. Then you've got some conviction to test a level, to lean against the level at least. For now, it looks like we're between there and 109, 109.10. That's going to be where we need to break above to see the pound recover further. Again, it's a similar picture. You know, you're looking on where to find support or where you're finding resistance, multiple tests of an area with some time in between. The more longer it carries on, then you've got a bit of conviction, but watch out for quick tests of these levels. If we test up to 109 here, like in this one, move down to maybe, you know, 108.5, 108.20, come back up again, you know, see a series of higher lows, maybe like what we're seeing here, that sets up the potential for a break. So it's always about what the price action does. But yeah, it looks like main levels here, down at 105.20, 105s, 109.10s for now. Euro dollar, looking a little bit lost at the moment. We've been messing around in between this sort of 96, 97 area. Maybe we're going to see a bit of a widening of this up to 97.50, 95.50. Again, just look to see what develops in this area. Probably going to likely play the big figures and the half figures in this one. Again, volatility is still fairly high. Everything's being driven by bond moves. So this is more of a follower than a leader at the moment for what's going on in yields. Dollar yen, I'll have a look at quickly. Not doing much at all, really. Still can't really get up to this 145 zone. As Kay's mentioned, we have got the month end in play. Could be having a say in this one. I had a little short yesterday into the fix. I was feeling a little bit itchy for a short. So I've got in at 144.50 over yesterday's fix. Took some off, didn't manage to get a move. I didn't manage to get some off in this move under 144, even though I was looking at that area. Got out of some, got stopped at break even on the way back up this morning. I'm still liking this 145 potentially for a short, but I'll be keeping that fairly tight. Going to keep an eye on the fix today and obviously tomorrow to see what happens. It could be that we may be building up. This is a decent level yet again, so one to keep an eye on. Just one other one I want to look at. Gold keeping an eye on this one because I was trading it. Got stopped out on my trailer. I was short on a break at 65. Managed to get out just above this fib here, 18s. Got stopped out on the reverse on a break of this 41 level. This level is now becoming a bit of a pivot level. So we're going to be looking for a range potentially developing between this lows and the fib, between this 41 and then up to the big 75-80 zone. I may look to get into shorts if we get back up to there, depending on how the price action is at the time. Kay, do you want to have a look at a couple of pairs, mate?
Yeah, I'm
round Rowan.
Yeah, let me have a look at a couple of things. All right. First of all, and because the sterling is so hot right now, let's quick look on what's happening in the longer term on those UK yields, because everything is flying left, right, and center in the short term. But we are in a zone which could be interesting for the long term. So based on inflation, based on funding cost, people were starting to talk about this 6% on the UK 10s. Now, Bank of England is calming the nerves a little bit, and I think we need to respect now what's happening in between 3 3/4 to 390 and 5. It's a wide range, but it's moving that fast that we have to look at the wider range. And 534. This is a or 534, 5.5%. Before we can even think about starting to reach those percentages. So yes, if inflation continues to ramp higher, if because of now the Bank of England YCC, it is possible to go and have a look up there. But I think we need to, if they succeed to calm the nerves, we need to keep a close eye on what's happening now in the 3 3/4 to 3.85% zone. And I think it's going to be relatively important what is happening here. If ever yields start to come back down and we getting sub 3 3/4, 370, we might be in for a bit of a failure here. We are 40 odd BPs above there. Personally, I think we are going to, if we get a retest, to try and push higher again, because I don't really like what's happening in the sterling sphere right now. But be aware if or be careful if ever we start to get back down sub these 3 3/4. That just as a little apartheid on what's happening now. In the US 10s, I've been highlighting this 4% level and other members of the team as well many times. And also it's a retracement level of really the Volcker period down to what was happened in 2020. And the 4% is important. And as a matter of fact, yesterday we have seen several fund and money managers prop up and saying like, yeah, 4% is really interesting in the bonds, and they are starting. They are really looking at this 4% as well, which is always important for us, whether they are right or wrong. Knowing that the big money managers are looking at certain levels is really giving us a really good indication of where the big money is going. And that in the end, you can chart whatever you want. You can look at any pictures, any retracements, any indicators you want. But when the big boys decide to move, that's where the levels are really made. And this 4% in the US 10 years is really a big level. So keep that one in mind. If ever we would shoot through because of inflation remaining sticky, Fed had to move further. I'm going to go out on a limb here and say that it's not because we are going to go above 4% that the dollar is going to shoot higher. It all depends why it would go above 4%. If it is supported by economic growth data keeping up really well, which they do right now. I mean, everybody is shouting about a recession, but we're nowhere near. Data are not the short-term data are not supportive of such a big call yet, in my opinion. So if it is supportive by good data, then you can continue to buy dollars. If it is only due to inflation, and we've seen what happens in the euro, we've seen what happened in the pound, and in some other currencies, if it's only due to inflation, it's not because rates are ramping higher that the currency is going to get bought. And testimony is the euro and the sterling in the past weeks. So watch out if we get back to 4%. I wouldn't react on it until tomorrow evening, until the end of the month, until the end of the quarter is done, because there could be a lot of rebalancing to be done, because the bonds have been moving a lot, equities have been moving a lot. So watch out for the rebalancing in the bond and the equity markets until tomorrow evening. But if come October we move higher, if we move higher, make sure to know the exact reasons why we move higher. On the other side, I think the 370, 365, 370 now on the 10s is going to be an important level to watch. People are already talking about the lows we've done yesterday, 380. It is indeed an intermediate level, and we have seen when the 10s yesterday went below 380, all the dollars got a knock on the head. So keep an eye already on the 380 zone. Which is the low that we saw like the day before yesterday, and so on. So that's, I wanted to highlight this 4% in US yields. Quick look at let's start with the oils. We had seen this sharp move lower over the past weeks. And actually started, it's been going lower gradually. Yesterday, we had, together with risk, we had this rebound of the oil products, and it was already some rumors coming out that OPEC may start to discuss output cuts next week. So watch out for going into the early stages of next week. Watch out with what happens with oil. We are close to intermediate levels. It's trading around 82.5. So watch out if this would break around the end of for the end of the month. A move back up to 85 and 85 3/4, 86.5 is possible. If and when October, well, not if, when October will start, and if and when OPEC Plus decides anything, and it would disappoint the markets, watch out for the other side. It can move really quickly. We have seen that. I think levels around 77 by next week, the 3rd of October, I think, or is the 5th, is the meeting. So by the 5th of October, this downward trend line is going to be right on the support and the bottoms we have seen. So if it would disappoint the market, watch out for this 76, 80, 77 zone on the WTI. Yeah, the metals, I think it's gold, as I was saying already. It's all about the 1650s. Has to go above, but then has to hold as well. And for now, it's struggling a little bit. I think there's a lot of month-end going on in there as well, possibly. So I'll reserve my verdict for the start of next week before I even do anything. Fact is, and Ryan has been highlighting this also a few times, is this 1680-84 zone. If that caps again, then we may see another leg lower. But I really think, well, I'm at least going to wait until next week to see if anything happens. A bit similar in the silver. We are turning around this zone. It's now really getting to be a crossroad and watering down a bit. So I'm going to wait to see what happens around these MAs, which are around the $19. And then for the rest, I'm just waiting. It was quite interesting that we had these drops up 18, and we had a pretty fierce rebound again. So around 18, there's definitely interest in the market. So besides what's happening, as you guys all know, we are looking at not only beautiful pictures, but also listening to what the market is telling us. And just below this 18, there seems to be a real interest to pick up some silver here. So that's going to be an interesting one to watch as well towards the end of the month, start of the next. For the rest, I'm still of the opposite of the opposite opinion in the yen. MOF intervenes. Bank of Japan put it lower. They managed to kill the vol. And yes, okay, I mean, there can be a lot of end of month, end of quarter, end of semi-fiscal year in Japan, by the way. So the end of September always sees interest. It could be that this is the case why it's holding up so well. But I really want to see what happens next week to form an idea on the dollar. And I'm the opposite side. If they don't put it, if we don't start to break back below 143.75, I'm not going to turn around and start to be bearish on this one. For now, I think that October, bearing in mind we still have that QT going on in the States. The data in the States are not really falling out of bed. I still think there is a chance we are going for a real retest, and why not even creep a bit higher. And then I don't want to take too much of your time. My euro mix, as people know in the room, I was waiting for so long for this move, and then I don't know whether it's going to happen. So I re-entered just a tiny bit yet, for as long as it stays below 1967 here. Every rebound is getting sold in this animal. So I still think it's anyway, longer term it's very bearish still. But this is short term. Still looking to add if we get levels back around 20. And then the Chinese yuan. We've had this break of this 720. Yeah, it's a bit tough to look at precise levels when you have so much intervention, not really selling dollars, but intervention by the PBOC, whether it's injecting liquidity, supporting the economy, and then at the same time telling people not to be short the yuan. To me, this one here, where we had the acceleration, this zone here, 700, 703, if they succeed to put it back down there, it's going to be a very interesting watch. And what I took this as same as Ryan. I'm having a stab at this dollar CNH due to the warnings, but I'll be looking on any setbacks to try and re-enter longs in there as well. The big zone to me is now going to be 690. One last one for those watching emerging markets is the dollar rand. We had this big spike higher, and now it's trying to put a top in place. So keep an eye on if ever dollar rand could make it back down to around 1760, 1750, 60 for the end of the month. Who knows? That's going to be a very interesting level to watch. And then I was planning to show a last one. Yes, euro sterling. Okay, the euro sterling here. It's been very whippy, but we can see a bit of a channel here that we have developed lately, and it's trying to get now below. I do think it's end of month stuff now being in the mix with this Bank of England stuff, but I'm a little in there, and I'm going to keep an eye on what's happening around this 89, the figure 88, 90 zone, because I think sooner or later I'm not a sterling bull, so sooner or later we may start to find a bit of a bottom around here. But anyway, for the day at least, it's going to be interesting to see if we can close back above 89.25 again. If it's below, we have to be a bit careful. And really, Ryan, I'm going to keep it at that for today.
Yeah, no problem, mate. Right, just quickly, let me do this. Let me do that. Just to give you an insight into what happens in our room. Okay. So obviously we had this PBOC news. I jumped into a trade. Kay jumped into a trade. Okay. Now, what we do in our chat room is, as humanly possible, we have a trade room, and this is where we put our trades, usually with the reasoning behind it. So there you can see everything I've done on this trade since we've been talking on this show. Got in, got some off, got a bit more off, moved my stops down. This isn't for signals. This isn't for people to follow. This is how we set our trades out so people can see how they work, what goes through someone's mind, how they plot trades, how they plan trades, how they manage trades. We do this in real time. You can see the clocks on there while Kay was talking. I was updating the room. It's very important that if you're in a community, you have this transparency with trades that people put in. It's no good me turning up a half hour later saying, oh yeah, I sold at 7.18 and I bought back at 7.13. Anyone can do that after the event. If you're looking to trade and you're inexperienced and you're not sure how to go about it, then there's loads of traders in our trade room who will set out how they trade, and you can pick up ideas. It doesn't mean you have to follow them to the exact path. You go your own way. You find what works for you. But you will see that the mechanics of trading, how people manage their trades, what they do at certain points, is all done live. That's what the benefit is of our chat room. Because there's too many people who, oh yes, I've got this level here. They highlight a level in the chart, and if it blows through, they don't say anything. If it holds, they come back 2 hours later and say, oh yeah, I sold that level or bought against that level, and it's held, and yeah, I'm in the money. I'm going to do some victory laps. There's plenty of those people around this industry. What we try and do at ForexAnalytix, what I try to do at Forex Live, and even back at Forex Live, and even at Forex Flow, was to bring some legitimacy to trading, because there's too many hindsight heroes who hide behind their trades. It's not real when you don't need to be fooled by that. But anyway, back onto things. I'm not got an awful lot to talk about for the rest of it. Let's see if we've got any other questions in the room.
Ryan?
Nope.
Ryan.
Right, so I'm going to get back to my trading screen. Hello, hello.
Ryan?
You're there? Yeah.
Yeah, I've got a question there about Lucas on the EuroCAD. If you want, I can do it quickly. We still have perhaps a minute or two.
Yeah, go ahead, mate. Yeah, go ahead. We're happy to.
Okay.
Happy to answer the viewers' questions.
Yeah. Okay, Lucas. Yeah. About the EuroCAD. First of all, I'm putting in a little bit of a longer term. So people who have been watching our show know about this monster 134 level, right? But then going a bit closer about the EuroCAD, right here and now, we have to know we have to know that we are in end of month and end of quarter scenarios, and a lot can go on. But I'd feel a bit more comfortable if we get a close below 132.15, Lucas. On the other side, yes, and I'm still with you there as well, and people know that I like the shorthand on this one as well at times, but I'm a little cautious right here and now. It's an interesting one. We have the 100 MA around 132.77. Are you talking about the EMA? I'm not watching those things, to be perfectly honest. I'm actually not even watching a lot of moving averages on FX pairs because they tend not to. They're only passage. I don't see them when they hold or when they cap. It's often coincidence, because if we look over time, either they are far away, either they get crossed, and then if we look at those moving averages on a pair like EuroCat, for instance, it's tough to judge or to base a position on what's happening.
Don't be dissing the MAs, mate. Don't be dissing the MAs.
Don't get me started, because if we start to talk about next thing, you are going to ask me about the Dixie.
It's all relative. All relative. It's all relative.
No, but in the shorter term, yes, I am. Just to confirm, I am watching the 132.90, 133 zone. I want to get through fixings to see what's really going on. But yeah, I could imagine myself giving it a tiny try, and then leave a lot of room open to see what happens. But in the broader scheme of things, I'm with you. As long as oils hold, and keeping in the back of my mind, because we are not only tech-driven, Ryan and myself, we look a lot at fundamentals, and Canada is going to be a provider of gas and oil to Europe as well, LNG as well, but that's further down the line. So somewhere, if you look at the EuroCat pair, Canada should, in theory, be a pretty good currency against the euro to hold, providing that oil and gas prices don't collapse further, and that economic data are holding up. Because in the correlation world, when things are turning sour, euro pairs, just like yen used to be, tend to strengthen a little bit. So we have to keep a few things in mind when we trade certain pairs. So, but in essence, yes, I like this. And you know what? I'm really hoping that they overshoot for the end of the month, end of quarter, and then we can have a stab at it if it goes back into the 133s. If ever it breaks back above 134 and it holds there, then I think the party may be over for the Canada for a while. So keep that one in mind. So that's the only thing I wanted to add now for our friend Lucas.
Thank you very much, mate. Yeah, so I think we'll call that a day. Let's hope we get a more conservative day today. Some good volatility, not bad volatility. If markets are too jumpy, I don't like it. It doesn't suit my trading style. I tend to stay out a bit more. Anyway, thank you all for coming to the show. Thanks, Kay, for your input as usual. Have a great day, everybody, and we shall see you tomorrow. And it's Friday. Yay.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.